Good evening, everybody. I am Rob Moffat. I'm a partner with Balderton Capital. This is our office. We try to run a bunch of events like these around industry topics, around functional topics, and for our portfolio. This is, however, the first of its kind. This is the first Balderton debate. We've chosen the first topic as something close to my heart and something controversial, which is Insurtech. And the idea is to get a robust debate going and avoid one of those panels where everyone agrees with each other and get a sort of more ferocious debate. The idea is that the crowd is very much involved in this, so please be ready to make contributions, comments, as well as questions. So Oscar will be hosting this evening. Oscar is one of the senior reporters at Business Insider, having previously worked at titles including the Evening Standard, and is an active enthusiast, I guess, for fintech and technology sector in general.
That's fair.
So without further ado, I'll leave you with Oscar, and he will take it from here.
Thank you, Rob. Hello, hello. Yes, welcome everybody. So as Rob said, this is the first in the series of Balderton debates. So it's an experiment, it's new. Bear with us. We might work out some kinks, but hopefully it'll be exciting, it'll be stimulating, and we'll all come away having a new perspective on some of the topics we're talking about. The way we're going to do this is we've got two debates, 3 speakers on each debate. There'll be somebody arguing for the motion, somebody arguing against the motion, then a rebuttal, and then somebody else arguing again against the motion, and then, yeah, that'll be it. And then there'll be, so I'm just trying to work it out in my own mind. As I said, it's an experiment. And then we'll have questions from the audience, and you can put your points across. Hopefully we'll get a conversation going. As it's a debate, we're also trying to change your minds, hopefully. So before each topic, we're going to have a vote to see how many people agree with the motion. And then at the end of the debate, we're going to have a vote to see if the balance has changed. The first debate we're having is, to really disrupt insurance, you need an insurance license. So I'd like to welcome the speakers for this first topic. First up, we've got Imran Akram, who is a partner at a $275 million fund backed by the insurance AXA. Before he came to AXA, he knew nothing about insurance, and his past investments include Auto One, Quando, and Treatwell. But after a year of running this fund, he's a bit of an expert. So, Imran, could you? Oh, come on, move to the upper chairs. The upper chairs. Taking him on, we have first up Freddie Mcnamara, who is the founder and CEO of Cuvva, which is an Insurtech startup that lets you book cover on your car for as little as 1 hour. And he was telling me just before we came on here that he started in 2014 and it took him a long time to actually get people to buy the product, but now he's done it. Like Imran, he's an expert. Come along, Freddie. And finally, again, it's a bit of a lopsided debate, this one, so we'll see how that works out. We've got Stephen Mendel. He's a qualified actuary. He's worked at McKinsey and Barclays, and 5 years ago he founded BoughtByMany, a social insurance provider that helps people find deals on sort of bespoke and niche insurance. Is that fair to say, Steve? Something like that. Come on up. So as I said, the first motion we're going to be sort of debating here is, to really disrupt insurance, you need an insurance license. So before we kick off, can we just get a show of hands? How many people agree with that? To disrupt insurance, you need to have an insurance license. What's that, about 10 people, do we think? So 10 people? It doesn't look like a lot. Okay. Hands up for against that. You think you don't need. Okay, well, that's pretty overwhelming there. So against is 1 there.
Should we go now?
Yeah. Well, no, he's got a lot of wide open space. He can win a lot of votes here. So, Imran, you've got your work cut out for you, but you're up first. Tell us why you do need a license to disrupt insurance.
Hello? Yeah, cool. So, as we said, the motion before us this evening is that to really disrupt the insurance industry, you need to be licensed. And to put the case briefly, before sort of expanding on some of the different points, I'd start with just saying, look, what is an insurance, right? And it's very simple in essence, right? You've got somebody who has been convinced or had something happen and they're worried about some risk that is coming to them, right? Whatever it is. And I go to somebody who is better able to deal with risks, who's probably sitting on a pot of money somewhere, make a small series of payments to them over whatever period it is, and I rely on them when something goes wrong to either just pay me back directly or do something that's going to help me. My house floods, my car breaks, whatever it is, they help me out. And I think that the insurance side of it is very simple, right? Like if they don't pay, what happens to the insurance industry? It's exactly the same as in banking, right? We all go to banks, we make deposits, we put money away, and even though sort of everyone in this room knows those guys aren't holding enough gold coins to pay us back, we rely on it happening. And if it ever goes wrong and we turn up and we don't get the money, the whole system collapses. So you regulate it, right? You make sure they've got enough sitting there to deal with it. I think insurance is exactly analogous, right? Like the temptation anytime you get all those little payments is you spend them, right? Like why save that until somebody comes back? Because, how often do you get, tornadoes in Houston or floods in India or whatever? So I'd say, put it almost the other way around. Like anything that is insurance has to be regulated, otherwise it doesn't really work. And within that then, again, what is the actual insurance piece of it? It's the bit where you are thinking about these frequencies and severities of the different incidents that are allowed to come up, that are possibly going to come up. Right? How often do you get floods? How often do you have accidents? What would it cost? And if you don't get to play with those risk models, then you don't get to change pricing. And you need to own those risk models to be able to convince the regulator that the pot of cash you're sitting on in the back is going to be enough when something happens. So that's the short version. The longer version, I think you can pretty, make sense. You go back a little bit to how Lloyd started, right? I'm there. I'm starting my new merchant fleet to go off to India and bring back lots of money. Let's call my ship the good ship Balderton. And I'm a little bit worried, I'm sort of confident this thing's going to work, but what if it sinks, right? What if there's a flood, the French blow it up, something happens, anything could go wrong. So I now need to go find someone who knows someone in Lloyd's. So I go ask my buddy with some drinks and some persuasion. He gives me another friend who knows somebody. He then takes me to a guy who actually works at Lloyd's, and I sit down and I explain my case with a lot of hand-waving, with some more drinks, and eventually this guy gets persuaded to take me to Lloyd's. This is basically the way insurance always worked. It still works this way at the corporate level. And I go around and I have to basically persuade a bunch of people to sign their name on there and promise me that if anything happens to the good ship Balderton, I get paid out. And then again, what happens now when it goes? I don't go back to my buddy who introduced me to the friend. I don't go to the restaurant owner or the provider of the port or the guy who gave me the parchment or any of these other things. I go to the guy who promised he would pay me this money and say something went wrong with the boat, now you need to pay me. And as we all know, Lloyd's had issues with this, right? And that's exactly when things started getting regulated, right? And if you go back to what the FCA calls it, right, as a regulator there, it's kind of everything around the affecting or the carrying out of the contracts of insurance. Not the bit at the front where you need to make somebody worry about, what if you die and your kids get, they're left without that? What if you lose your job and you can't pay your mortgage? That bit isn't really insurance, right? It's marketing that gets you to the point where somebody wants to go and do the insurance contract. And as they point out, the regulated activities order, which brought this all in, doesn't try an exhaustive definition of, what is a contract of insurance. For that, you have to go back to the Bank of England. And their explanatory note also is of the same view. It says it's an enforceable obligation to respond, usually by providing some benefit in the form of money or services, to the occurrence of an uncertain event. In other words, an enforceable obligation to respond, what we might call insurance, is a licensed activity. So with all respect to the opposition speakers, I'd say it's sort of the same with everything else. Like whichever way you cut it, I can cut it into episodic insurance and say, okay, I only want my auto insurance for an hour. I hope you can still have drinks with me afterwards, by the way. I can say it's peer insurance and that somehow this pool of people is less likely to claim because they know all the other people they're looking at in the room. Whichever it is, if I go buy hourly insurance and I crash into somebody else, the regulator wants to know that the insurer can pay the bill. That in the end is all that matters, right? And so they regulate it to make sure that happens. The fact that it's a new broker who's got a mobile app, they've got a responsive website, they found me through Twitter, they had a chat conversation with me on Facebook to sign me up, and I confirm my identity with a text, doesn't change the fact that in the end I've signed an insurance contract with that licensed entity. Right? And if I take a view that actually, you know, a guy with a beard and a pink shirt who drives or rides a Brompton to work is less likely to claim on pet insurance for my Labrador, it's irrelevant unless I can convince the licensed entity who owns that risk model that they should change the pricing. And I think that in the end, if you look at most of the stuff that's happening in Insurtech, like that's it. All the top layer is changing, but in the end, you need to convince the party who's holding that risk, who needs to be able to convince the regulator that you can use all these different data sources. So what's happening, right? Like a lot of money has gone into these front ends, into the mobile brokers and so on. I think if you look at it, a lot of the parties who've been in business for some while are now starting to go the license path, right? Something like, you know, GetSafe, the mobile broker, has announced they're now partnering up with an insurer so that they can basically, you know, take use of that license to be able to start experimenting with more of this pricing. Guys like Elas Direct in Greece, they're an auto insurer, plain vanilla auto insurer from the outside, right? Like that's, you know, they do what every other one does, but they built their tech stack end to end and they raised, you know, the tens of millions they needed to become a licensed entity. So they don't need to go convince anybody else about the risk dynamics of a smart car owner. Like they can use the data and make the changes to pricing themselves. Autonova would be another example in Germany, right? Those guys, I can't remember how much is public. What is public is they've raised a lot of money and they haven't launched, right? And it's the same thing, but it means end to end they own it and they can change what they're doing. So to summarize, I'd say, look, you know, insurance is in the end just that simple piece of saying, you know, I will take a risk of something that is unlikely to happen to me but would cost a lot if it did, and I rely on somebody with a big balance sheet or big gold bars sitting somewhere who's going to pay out in that. And that thing itself that is insurance is precisely what has to be licensed. And if you don't get to be in that flow and change the risk models, change the amount of capital it's saved, or change what's being paid out, then you're not really disrupting the insurance industry.
Thank you very much, Imran. Thank you. Let's hope the French don't come and blow up Balderton. Now, against the motion, saying that actually you can disrupt insurance without a license. First up, Stephen is going to tell us why licenses are for schmucks.
Those exact words. So the motion, just to remind you precisely, is to disrupt the insurance industry. Do you need this? Do I need anyone not here? Oh, to disrupt the insurance industry, I hope I say something that's worth videoing. To disrupt the insurance industry, you need an insurance license. Actually, I completely disagree with this. To disrupt the insurance industry, you need a proper consumer-centric product offering. This is nothing to do with a license whatsoever. And to be able to have a proper consumer-centric offering, there are three elements to that. The first element is that you need to have a proper consumer-designed product, a product that's built around the needs of your customers. And I'm not going to talk about that right now. My esteemed advocate colleague, Freddie, will talk about that a bit later on. So that's the first piece, that's the product piece. The second piece you need to properly disrupt the insurance industry is you need to understand the language of your customers, the language that people out there who are buying your insurance products are going to be using. So let me give you a really important example of why language is so critical here. So in this motion, we've talked about the need to have an insurance license or not. BoughtByMany has an insurance license. We're a fully directly authorized insurance intermediary. We don't have a balance sheet, but we absolutely have a license. And we are able to go out there and build an insurance offering around our customers, understand their language, and build what it is that they need. So this is not a mission critical issue. And the third piece, after product and after language, is access to customers. It's understanding what channels your customers are likely to want. So if you have the ability to get access to your customers, then you can understand what it is that they're looking for, and you can build a product that they want. Now, we would strongly advocate that a very important aspect of that is your search and social media attitudes. This is a very important part of who BoughtByMany is, and it's very important to us that we understand our customers and our potential customers so that we understand the language that they want to use, and that we are able to build a product around what they're looking for. So let me take this into a different sphere, because I think that really what this motion is getting to isn't really about license, it's really about balance sheet. So I think that the piece that Imran is really looking for is that to disrupt the insurance industry, you need a balance sheet and not a license. So if you think about the importance of a balance sheet for a second, I'd like to take you into a different sphere, into an analogy from another industry to show you that in other industries, balance sheets aren't required either. So the example I'd like to give you is Airbnb. So I don't think there's anybody in the room here who would argue with my assertion that Airbnb is a massive success. In fact, at their last fundraise, Airbnb were raising money at a valuation of some $31 billion, right? This enormous number. That $31 billion, by the way, is just $7 billion shy of the valuation of Marriott International. Marriott is the world's largest hotel chain. Airbnb doesn't have a single bed. It doesn't have a balance sheet, and yet it has built a business that is hugely successful and, of course, hugely valuable. And I think the implications for the insurance industry are exactly the same. So I would ask you very strongly to vote against this motion. I think the notion that you need to have a balance sheet is complete and utter nonsense. And you do need a license, but the criticality here is to be an intermediary, to understand your customers, to build products through the channels and understand your customers. Thank you very much.
Yeah. Imran, have you got any rebuttals? He's got his notes there. You're in for it now.
I am. So, I mean, the first part of that to disrupt it, you need to speak the language of the customer, make a product they can reach, and understand where they are. I don't think I'm going to argue with, right? Like I'm all for all of those. And I was actually going to save that you're licensed until now, but thank you. It's like, you know, so I think in the end it's that, right? The motion is on the licensing, right? So for you, I think the difference in the analogy of something like an Airbnb, they don't care about the asset, but what they do care about is their control over what's delivered to somebody during their stay, which doesn't use up the thing, right? And whether they fund that asset and they own the house or somebody else does it is irrelevant, right? The service is different than that balance sheet thing. But in the insurance industry, that's precisely what is servicing you, right? Like, it's no good to me to sort of theoretically have my car repaired when I have an accident. Like, my car is broken and someone needs to pay for it. Like, at that point, it's the balance sheet that pays out and deals with that issue. And I think going one step behind that, or sort of before that, take somebody like Admiral in the UK. They also don't sit on a lot of stuff that's on their balance sheet. But for me to go convince somebody else that this set of risks that I've originated is worth them holding, my risk model matters, right? And my risk model would have been audited, and my risk model would have been checked. And that comes back to the piece that's licensed. So if you take mortgages, for example, right? You've got retail banks originating a whole bunch of loans. For a period, it can work if nobody looks at it, right? Like, you know, the dog walking around here can take out a mortgage on the good ship Balderton, right? But, like, no one's going to buy it once they realize it's a dog. So I think like that piece is what the auditor looks at, right? Like that's what's licensed. And you're right, whether I end up holding that or not is an irrelevance. But the insurance piece of, as I say, building that risk model, understanding what's coming and then being able to package that up into a way that's attractive either for me to fund or a reinsurer or somebody else through the open market. Like, I think, that piece is critically needing a license.
Thank you very much. Right. Freddie, it's all on you now.
Right. I'm going to stay sitting down because I'm going to read most of this. But I'm actually going to I'm going to sort of question your definition that of the relationship between the underwriter and the distributor, and whether or not they need to act as two separate organisations, or whether or not they can act as essentially one, and what the building blocks are there. It's widely acknowledged that the battle between startup and incumbent comes down to whether the startup can get distribution before the incumbent can get innovation. And in insurance, there are two overarching factors that determine whether, as a startup, you can get distribution. The first goes to innovation. Are you solving a unique, acutely felt problem that satisfies a pain point for millions of people in a way that they cannot solve through alternative means? And two, and this one is key, is the price competitive with that of the alternative option? Now, our appraising team should have argued that there is a misalignment. I thought I was going
Come on,
first.
Imran.
Our appraising team should have argued, I thought I was going first, that there is a misalignment of interest between distributor and underwriter that will cause the underwriter to overprice and convert VC dollars in the pocket of the startup into return on capital in the pocket of the underwriter. But by way of stratospheric cost of acquiring these overcharged customers. However, this ignores one thing, a thing that is so important in insurance, and that is trust. At Cuvva, I spent an entire year in negotiations, discussions, and diligence, attending to the concerns of our first primary underwriter. You think that raising capital is a high diligence process. All you can really lose in venture are your table stakes. In unlimited liability underwriting, the liability is unlimited. As a result, you really need to trust whoever is holding your pen. Trust that they are distributing these contracts to the people you want, and trust them to be collecting the correct amount of premium and commission. But once you've gained that trust, you can then have an open and honest discussion about pricing. We have found that the single underwriter approach at inception to be incredibly powerful. We're able to bring to the table a groundbreaking product that has no track record, work with our underwriters to put in checks, controls, and protections that have limited their downside compared to the wider market, and then over time, in a gentle, softly approach, through quarterly reviews, monthly calls, and weekly chats, build distribution and build track record, and ultimately, the Holy Grail, move price to a lower point than the wider market. In fact, I would go as far as argue that this approach is the only successful way of launching a new, lean Insurtech business, disruptive or not. Slowly, patiently building distribution and track record. Yes, of course, you can go and get a license, find someone to capitalize that balance sheet to the minimum requirement, find someone to capitalize the growth engine, and then launch your shiny new idea into the market and scale it from zero. But I would argue that this approach is short-sighted and recklessly risky. My advice would be to go forth, work slowly and steadily to build trust with an underwriter, borrow a tiny sliver of their balance sheet to test your idea, and you can worry about who's getting all that combined ratio when everyone is buying it. I rest my case.
Well, there we go. We've heard from the two sides. Now it's time to bring in all of you. So please, questions, points, rebuttals. You sit at the front. Yeah, why? Yeah, let's do it. Yeah.
Mike Ballerman, London FinTech Podcast. I think the first point I make is probably not helpful, so we should probably gloss on and move over, which is whenever I hear the phrase Insurtech, I really realise that I'm hearing a collective description. So there is, for example, catastrophe insurance at Lloyd's, there is car insurance, there is so-called life insurance. They're actually very different businesses with different characteristics. So any generalization is a bit problematic. I think without getting into sort of legalism about the precise wording of the debate, I think the challenge is around the pricing of the risk, as you say, which is if, for example, the reinsurers, and Munich Re springs to mind because they're doing the best job of reinsurance as a service. Let's say, for the sake of argument, Munich Re will provide an Insurtech that doesn't have an insurance license with insurance capacity as much as it wants, but it charges 10 times what it costs to have. In those circumstances, I think this side is right, which is that you can only disrupt that by actually pricing it much better. Even if, for the sake of argument, they charge it at 1.1 times the cost of the risk, then this side is right, because actually there's plenty more fat. And I think the weakness on this side of the argument around the risk and the pricing of the risk is a failure to understand the difference between risk in banking and the risk in insurance. As John Kay has made very clear in his book, Masters of the Universal Servants of the People, bankers are like a group of people who go to a pub, they play a poker game amongst themselves, and they bankrupt everybody who isn't in the pub. So in that case, the risk is actually sort of endogenous. It's within them, and it spreads out. In the case of insurance, the risk models are, of course, very important, but the risk doesn't lie within the insurers who have gone to pub together. The risk lies outside. Is somebody crashing their car? Is somebody dropping dead? So I think this is the thing to me which actually swings it one way or another, which is that for those insurtechs who haven't got an insurance license, the price at which they get the risk is at a fair price or not. Historically, 3 years ago, I'd have voted this side. I said it wasn't. But with the likes of Munich Re doing quite a good job, I'd say actually that it's swinging to this side. But it really is around the pricing of risk. Are you, in a sense, as an insurtech, being ripped off by the insurance industry? Because if you are, all you're doing is putting lipstick on a pig. Or are they giving you a reasonable price, in which case there's quite a lot of fat?
Does anyone on either side of the panel have anything to contribute?
Go on.
Yes, like Munich Re and the other reinsurers have done a great job of putting lots of theoretical underwriting capacity behind lots of firms at a small stage, right? Which makes complete sense from them. Some of them are sitting in the room. So, because why wouldn't you want to cut out these intermediaries who are getting between you and the customer and, take more for yourself? But what does that actually mean, right? Like the beauty of it, and I've been having the same conversation with different bits of AXA, is like, I can tell you I'm going to give you 10 million of underwriting capacity. When you launch, which is the first thing that wipes out lots of the people they write it to, because they never get to that point, so who cares? Subject to, and that's usually where it comes down to, right? So yes, there's softly, I can go persuade them that, okay, actually now I don't need someone to walk in and show me or, have a 10-year address history. I need like a 7-year address history. And I don't have to directly get them to sign it. I can rely on something I looked up, right? But these are all bits of it. In the end, the point you say is the right one. Is like, what is the real risk? And what are all the sets of data that would help me understand and better price that risk? And also the potential impact, whether it's hurricane or, my goods get hijacked by Somali pirates or whatever, right? So who gets to play with that? And I don't know, I go back to like gaming companies are invested in, like we do tests all day, every day, right? I want to put a button on a page, what color should it be? Like actually we just they stopped picking. They would just put N buttons out there, and at the end of it, it should be color 327. And the thing is with all the new things happening with insurance, is like if you don't get to play with that, if you don't get to do all these tests of all the different color buttons or which form of address verification matters, then how do you make it better? How do you find out whether actually you were pricing 10x or whether you were pricing within 10%? And I think that's the thing that's challenging. And it gets even more complex the longer cycle, right? Auto insurance, within a few months, enough people have crashed enough cars, you have a good sense of whether you were right or wrong. Life insurance, you have to wait a while for people to die, right? And you really don't know.
Any more questions from the... Well, let's hear from the floor. We can work things in. There's a lot of people out here with a lot to say. I'm just going to chuck this back, and then whoever, yeah.
Hi, cheers guys. I feel he's a bit outnumbered, by the way. I was initially voting on this side of the court, and now the underdog has just got me feeling really sympathetic. So I'm going to attack you two, even though I don't agree with the premise. Stephen, you gave an example of Airbnb, and I thought that was a really good example, but what it washed over was the inventory of that was the right to host people in your house. Now, if that had a license behind it and you had to have a solvency requirement, a bank account with 50, 60,000 pounds in it, how many people would list their house on Airbnb? So the inventory evaporates and their whole business model is kaput. So that's a slight flaw for me. But the actual real issue here is if we're going to be really serious about this debate, you're kind of right. You do need a license to truly change the rating and the structure. But the reality is that to get one is very, very expensive. So what the industry should probably be doing is saying, well, why couldn't Freddie get a license to start with? The FinTech podcast gentleman at the front made a very, very salient point on talking about banking. Well, the banking industry has had a precedent of printed capital to recapitalise its balance sheet, yet the industry in insurance has said nothing to ask for, say, £3 billion of QE to give Freddie his red cap that he would have required. So there's no innovation really as a holistic in the industry to try and acquire that. And Stephen and Freddie and I were at an event recently debating that with the government. So I felt that case was a little bit weak because you argued about disruption, but you didn't mention how it was actually going to happen. And if we look at the two cases of disruption in insurance, the mass disintermediation was Direct Line, had a license, which would have been a valid point. And the second one was comparison sites, did not require a license. So it depends. When you said disruption of insurance, that's a huge supply chain and market. What were you speaking about? The distribution, the actual underwriting? There's a huge spectrum of risk there. So I felt that was a bit lacking. But great debate, and brave to stand up against two such bearded men. Well, one's bearded. Freddie needs a beard.
I think we'll let's hear some points from the and then the gentleman at the back there after.
Hi, Ian. Just a quick comment in addition to that on the Airbnb analogy. I thought that it was a bit fallacious in the fact that the analogy would work if Airbnb was sourcing their rooms from Marriott, but that's not the case.
The gentleman at the back there, thanks.
Hi there, it's Louise. So I used to be the regulator, so I'm going to bring that a little bit of that flavor here. I guess if we asked around what disruption means, you probably get 4 different definitions. So I'll give you mine, which is taking revenue from the person you're trying to disrupt. So to disrupt an insurer, you need to underwrite the risk to be able to disrupt them. Otherwise, you're disrupting the brokerage market, if that makes sense. So the only way to disrupt an insurer is to be able to underwrite, and therefore you can take revenue from them. So that's I think that's probably worth highlighting what we mean by disruption. And I think for me it's very clear you need to be a registered insurer to do that.
Pro insurance lobby over there. Yeah. She's got a fan.
So I'm going to question that entirely and go, well, we've focused entirely on distribution and things like that. But actually, if we take a step back, there's a whole bunch of people or objects or institutions that disrupt insurance, from Microsoft because they've invented Excel many years ago, and that's entirely disrupted the industry. The internet has disrupted insurance. Regulators, governments disrupt insurance all the time. So I don't really see why that focuses entirely on distribution.
Oh, over there.
Sorry, I'd like to ask in very simple terms. What does a license actually encompass, and what limitations does that impose on startups who don't have one from someone who is outside of the industry?
Let me retrieve the mic here. Thanks very much. Right, who's going to answer that one? That answers that then.
I think the answer you're looking for, in practical terms, what does this actually mean? To be able to quote and bind, so that means what that means in language is that to commit an insurer's balance sheet on behalf of the insurer, you need to have the authority to do that. And to be able for the insurer to pass you that responsibility as an intermediary, they need to have some sense of how responsible you are as individuals. And the best way of assessing that is by looking at your regulatory position. I think really this is what the crux of the conversation is about. And there are many different licenses possible, but the direct intermediary, the direct advice license, is the kind of the gold standard of that. There are many tiers of intermediary license, but this is the top one. Does that help? I don't know. Yeah.
I think there's a little patch of people over there who've been waiting for a while.
Hi, I'm speaking from a broker perspective, so people often tell me I'm going to get disintermediated. However, I'm actually a consultant for a broker. So my job is to think about value chains a lot and where different people fit in. And the way we've seen a lot of tech affecting insurance traditionally has been to make value chains shorter. And in those sorts of circumstances, you often do need a license because you're taking somebody else's role. However, I think as we move towards more of a platform-based technology where you start to connect people and add value in other means, we're actually seeing value chains get longer. And when you've found a way to keep participants in that chain who have licenses, you can bring in things like pricing enhancements, you can bring in things around distribution such that you're offering a wider pool of participants into that chain. I think there's a huge amount you can do. I don't need to give you the examples that adds value and takes revenue, as you put it, without actually needing a license yourself. So any comments on that? I'd be interested to hear, but can carry on with questions otherwise.
I think there's one. Yep.
I think a slightly rhetorical question, because I know the answer, but does the panel think there's any kind of lack of capital and insurance license in the market? So the answer to that is no, there isn't. There's absolutely no lack of capital. There's no lack of insurance license. So to say that we do need one to disrupt it, I think is a bit folly, really, because there's an absolute oversupply of capital insurance license. So the real kind of deficit is the product innovation, and to say that you need a license to do things like pricing, again, insurance carriers, the ones with the licenses, aren't exactly the world's best necessarily at pricing. There are new ways of pricing, new ways of gathering data, and that's not just the premise of those with an insurance license. So definitely with the guys on the right.
Well, I'm quite conscious of time, so would either side make some final closing arguments before we go to a vote again, or are you? Let's vote. Let's vote. That's probably the easier. Or
well, sorry, is it like there were lots of different things there, right? So I'll do something the other way around, right? In terms of what does a broker do? McDonald's at one end, for example, you walk in, you don't need anyone to explain the menu, and they're getting rid of what all the serving staff do, right? Like you can walk in, order by an app, and I know what a burger looks like, right? At the other end, if you go to a restaurant and you want to go through a wine list that is 3 pages long, paired with 3 courses of food, whatever, like I think there's a different degree of understanding of the parties on both sides of what they're buying, and to what extent you're able to specify what you're buying in an easy to understand way. Right, so when I think about the comparison engines and so on, they've done auto, not even necessarily that completely, right? So you can go pick people pick the cheapest thing. You don't know that has breakdown cover or chipped windscreen cover or legal blah, blah, blah. Like none of these things are really in there. So one of the things, for example, that we've invested in is a company that helps you go through the documentation for a bunch of the different policy providers to actually do a fair comparison. And you might still pick the cheapest, but at least now Policy Genius in the US. Yeah, people frightening me. But to try and better understand what it is that you're buying, right? And it may be some of these things don't matter to you. There's some element you can easily explain without necessarily needing the person. You can, on the other hand, if there's a cross-border trade finance deal where something from here gets shipped to someone in China, has to get it inspected at different points and cross the border and so on, there's a lot of risks and parties involved, but I think there is value in piecing some of that together. Then someone was asking, like, why are we talking only really about the distribution? And I think that, I think actually that's the end which probably has the least interesting disruption to the industry. And it's exactly analogous to like every other industry, right? Like we don't have brokers so much now selling you asset management things or ISAs and so on. Most people go on, well, not most actually, like an increasing proportion of people are just going online and putting money into those. But that's kind of the easy place to start. I think all the really interesting things are trying to work out, okay, what does having a 30-year heart rate and step and activity history about a person, together with what they're reading and where they travel to, tell me about their likelihood to die on a life insurance policy? That's super interesting, right? And it lets me bring the pricing nearer to the risk. But in the end, I think, like, we do want more insurance. And, how do you get it in there? Like, it's trying to encourage lots of these experiments. I think, yes, there's a lot going to the balance sheets, but in the end, I think, like, the core insurance bit is just, there's a risk that gets given to somebody, and whether you tell somebody else, like, here's the parameters within which you're allowed to sign yes, or like it has to be in this box, like that's the bit that's the insurance that you really want to do the experiments with.
And the innovators?
I'd just say that at the end of the day, it comes down to pricing, and the opposition's argument is that the only way you can influence pricing is by having your own license. I think that's rubbish. You can work with underwriters, and as long as you have a trusted relationship with them, you can influence pricing together, and you can use all the data that the startup is accruing to feed back to the underwriter, and you can make logical arguments for why the pricing should be better. And the way you disrupt incumbent insurers is by using better data to de-pool the really good risks into your pool, leave them with the crap risks, and you de-pool people by getting them a better price in the market. So I would, that's my conclusion.
Right, let's vote. We've done our debating, and just to refresh your memories, the wording of this motion is: to really disrupt insurance, you need an insurance license. Now, at the start of the debate, against won pretty handily. There was only probably about 10 or so people in the room who supported for. So can I just ask again? So hands up, people who do support the motion: to disrupt insurance, you need a license. I'd say a bit of ground gain there, a little bit. Yeah. So you've changed the minds, Imran. You've changed the minds. And now, against who? Yeah. So you've made up some ground, but I think against carries the motion. It was an unfair fight. Thank you. Yeah, thank you. Yeah. Thank you. Thanks to our panelists there. Now the second motion for debate that we have is: customers can be persuaded to love insurers. Perhaps more contentious, this one. And I'd like to welcome up our participants for this debate. So first up we have Rob Devey, who is an investor and advisor at Octopus, Blenheim Chalcott, BoughtByMany, and Urban Jungle. He told me he's previously run incumbents, general insurers, life insurers, and wealth managers. So he's really run the gamut on this one. I'd also like to welcome up Sophie Dingreville. She leads Munich Re's VC activities in Europe. As we've heard previously there, Munich Re is the world's largest reinsurer. Sophie's been in venture capital for about 15 years and was a partner at Iris Capital prior to joining Munich Re. And finally, you've already heard from him. I'd like to welcome up Rob Moffat, who is, of course, partner at Balderton Capital. And this is his own words, he worked at Google before joining Balderton on their ill-fated insurance comparison product, Google Compare. So yes, can customers be persuaded to love their insurers? Let's start off. Rob Devey, over to you.
So I'm going to argue in favour of this. And the reason why I'm going to argue in favour of this is because they already have. Okay, there is historical precedence of love. That may shock you, but it's true. I have had the absolute privilege of running two of loved brands in the UK in the insurance world. So I ran HBOS's Insurance Halifax, and I ran Prudential's insurance business. And it's just absolutely fascinating to talk to customers there, older customers, about how they saw their insurance. Now, love here is in the Shakespearean sense of love. It's not I want to jump into bed with my insurer, okay? But it is that I have a deep, deep regard and trust for this institution. You know, there are two institutions in financial services that acquired the definite article, the Halifax and the Pru. That doesn't happen by accident. That happens because that's a deep trust that's happened in the UK with those institutions, and that came through doing the right thing over a very long period of time. And I was able to evidence this, see this through talking to hundreds of customers and see how they felt about the brands. So I'd go backwards to look forwards on this. And why did they trust so much? Well, I used to dip into this all the time as I was talking to colleagues. I would dip into the history of the proof, for instance. World War I, 860,000 deaths of UK citizens in World War I. 30% of those were insured by Prudential. I read our policy documents from 1914. The policy document from 1914 said this policy does not apply in times of civil strife and war. So when the first claim came through from the front line 2 days after conflict started, there was a choice to be made. Should we or should we not pay out? It wasn't a choice for the people then. They paid out. And they paid out on the subsequent 300,000 claims that they had. That is where trust comes from. That's where love can come from. Okay, so that is how profound this can be. Because actually insurance is a profoundly important service. I don't talk product, I talk service here. It's a profoundly important thing. It's serving a fundamental need. The fundamental need for protection, for certainty. And that is hugely valuable and important to everybody. I want to know I am safe. And that's what we do. Now, that could be safe from death in conflict. It could be safe from actually finding I haven't got any money because something has gone wrong. It could be the dog's got ill. It could be, the car's broken out. It could be whatever. But it's hugely, hugely valuable. So this is a position of enormous strength and capability, I would say. This is an enormously valuable thing that we do. So how did we so monumentally screw it up? That people could possibly think that we couldn't love our insurers? Because we did. We collectively, as an industry, in banking, insurance, in financial services more generally, we made a monumental screw up of this. Why and how? Now, I look backwards again a little bit here. It didn't used to be this way. And then, we had innovation, all for the good, I would say. But scale started to become important. Okay? When scale started to become important, you went away from individual. The marginal cost was the same. There was limited fixed costs. It was all about the variable cost. Suddenly we had computers, we had Excel, we had the disruption of these things. We started to actually have some pretty big fixed costs with these things. We started to have regulation, big fixed costs that goes with that. Suddenly scale becomes important, actually, to be able to cover those fixed costs. So we started to put together, it became more important, become bigger and bigger and bigger. And with scale comes complexity. To deal with that complexity, what do? You try and simplify things. You get more distant from your customers. You also, actually, you can work really hard at that, but the other thing about insurance, about financial services more generally, there is a massive information asymmetry between customers and providers, wherever they are. They might be brokers, they might be insurers, they might be banks. It doesn't matter. We're in a position of enormous strength, and people are confused and terrified by this stuff. Do we help them or do we screw them? What was the answer then? It was actually, no, we'll screw them. It's too difficult to change what we've done. So we'll put the prices up, we'll change the policy documents, we'll renege on our claims. And actually, trust was broken down. And I think we have seen that. And so we start from a position where it's pretty tough out there. We're a long way away from love. So what do we do about that? Well, I think if you're an incumbent, it is incredibly difficult to do anything with it. I know I've run these places, and I feel passionately, as you can probably tell, about how important this stuff is. But turning around that supertanker is really, really hard. You can make incremental improvements, but the embedded complexity of the systems and the organizations is very, very challenging. So that presents an enormous opportunity for new entrants. Why am I not doing that stuff now? And why am I doing the stuff that I do now? Because I fundamentally believe in that opportunity. The opportunity is huge, but and it's big enough to overcome the embedded distribution advantages that the incumbents have. But we've got to be smart about how we take that. What does smartness mean? I think it goes back to a number of the things that the earlier panel were talking about, particularly on that side of the table. It's about really thinking hard about your products, it's really thinking hard about how you communicate, and it's thinking really hard about how you distribute and how you actually engage with your clients. I think distribution's a pretty bad word. I've always hated the idea of distribution because it gives the sense of it's one and done, it's gone. Should be about engagement. What was brilliant distribution, what brilliant brokers, what do they do? This is a deep relationship. This is an ongoing engagement. And again, this is where banks and insurers fundamentally failed, have fundamentally gone away from where they were to where they are now. And they're trying to fight their way back, really struggling. So models where people really think hard about that, think really hard about distribution, and technology and capabilities now allow us to do mass customization, to get very, very close to what customers actually want. And it's incumbent on us to then design the right products, deliver them in the right way, and service them, not just distribute them, service the entire customer life cycle. When we do that, customers will love us.
Thank you, Rob. Sophie. Sorry? Oh, I said this was experimental. She's calling me out. I forgot to do the vote ahead of this.
Should do it.
It's a bias sample. Well, you sure? I mean, they've heard his story.
Sure.
Is there going to be on his side? Okay. Experiment. Okay, let's do the vote here. So let's see if these guys can now change your mind. So, as a reminder, the wording of this one is: customers can be persuaded to love their insurers. Hands up who agrees with that premise. Everyone, a lot of love in the room. Now, hands up who is against that premise. They'll never love. You've got your work cut out, guys. Okay, Sophie, over to you.
So, insurance is not an incredibly exciting thing to have. I don't think insurer can inspire a feeling of love. Nevertheless, I think that it can inspire trust. The idea of insurance is complicated to begin with. Generally, consumers will buy an insurance when they're forced to, like home insurance, motor, health, or when they're guilted into doing so, life insurance. The only other contact with insurance will be at the time of filing a claim, which is generally a time of huge stress and time pressure. So the relationship is very bad, and there's a lot of confusion, anger, and massive miscommunication. So it's strange to me that the core of insurance, which is policies being sold by insurers and purchased by insured, is virtually impossible to understand by most customers. It's just a mess of conditions, subclauses, references to other documents. While customer will generally know the title of the insurance policy and the amount of coverage they have and the price, the specifics of the coverage are so opaque. And I think this is the first challenge in order to build trust between insurers and insured. The first challenge is to provide transparency, clarity around what the customer is covered for. And transparency at the time of the purchase, and transparency also when the customer is about to fall outside the bounds of the coverage. So a way to make sure that the customer is actually purchasing the coverage that he or she really needs and engage along the side. And this is really a challenge. There's this survey that was conducted in Australia where 88% of surveyed customers said that they think they had a confident understanding of their policy cover. But the same survey said that 80% of the customers did not read the policy disclosure statement. So customers are just looking for information online, talking to other people, but they don't know what they actually have, which is then a big complex, because in reality, when it comes to the claim, the idea of the insurer and the insurance being very contentious, the idea of an adversarial moment between insurers and insured, because insurance companies are rich because they don't pay claims, and because insured don't know what they've been covered for. And the other part is, on the side of the insurer, is customers fraud, because they assume they will not be paid the full amount of claim, therefore they exaggerate the amount of the loss. And this needs to be turned completely upside down. This is a challenge. Fraud needs to be limited with technology and data tracking. And also the insurer needs to engage with the customers earlier on in order to share subject matter expertise and to mitigate and even avoid the risk. So that's another challenge. And there's another survey that was carried by Accenture saying that customers having filed a claim over the last 2 years were almost twice as likely to switch insurer over the next 12 months when compared to customers who did not file the claim. And this was regardless of the quality of the experience. Therefore, it's clear that the challenge in building trust is a challenge of reducing the claims. And we know that reducing the claims is either reducing the risk, either find a new way of processing claims, a new way of filing the claims, a seamless way of filing the claims using the technology. So insurers need to find a way to engage customers in order for them to share data, customers to share data, and insurers to share subject matter expertise to improve loyalty and ultimately trust.
Thank you very much. Over to Rob number one. Any
I'd thank you. All I can say is thank you. Thank you for giving so many opportunities for love. Yeah, so what we heard there was all the reasons why it doesn't work today, why those incumbents are so poor at this. But let's take BoughtByMany, which we both love. Let's be honest, we love our insurer. But BoughtByMany, on your policy documents for our own products, you don't get your dog. You get a picture of your dog. Your dog is called Fido. It's never referred to as the dog or your dog. It's referred to as Fido. Little Fido. We're super explicit about what you're covered for and what you're not covered for. And actually, when you do things differently, it's entirely possible to drive, whether it's Cuvva's 71% net promoter score, whether it's our FIFO score, 4.7 out of 5. And these are of hundreds of people who have bought, hundreds of people who have claimed, and people who have had their claim repudiated. What an awful word. It's an insurance word. Denied. You know, if you're explicit, people are not unreasonable. Insurers have been unreasonable. People aren't unreasonable. You're clear, say what's in, what's out, you remind people of that. It's entirely possible to allow the love to flow.
Yes, I love BoughtByMany, you're right. But the customers will trust BoughtByMany.
You're winning votes over here.
Will trust BoughtByMany, but the moment BoughtByMany will help me having my pet healthy, then maybe it will inspire a feeling of love. But if it's just making sure that if something bad happens with my dog, I will be covered, it's just trust. I trust that they're doing the right thing.
Rob?
Keep going. Okay, I feel ganged up on here. Let me try. Okay, so let me start. As Rob started with Shakespeare, I'm going to start with Arthur Miller and Death of a Salesman. And the reason for this is I was looking for an example in literature of someone who loved their insurance policy. And the best example I could find was Willy Loman, who, for those of us who haven't studied English GCSE or actually read it for fun, it is, spoiler alert, apologies. He realized at some point that all he has to give to the world is his $20,000 guaranteed, gilt-edged $20,000 life insurance, which he wants to make sure goes to his family. And the way he talks about this is very emotional, it's huge love. And of course, the great irony is it wasn't going to get paid out because he was going to drive his car off a bridge. And that to me sort of shows the example. When he talks about the First World War and life insurance is probably the easiest product to love because it always pays out. If you're dead, you're dead. There is no debate around whether you were dead or not, whether you pretended to be dead, whether you exaggerated how dead you were, whether there's a ring of people who are all pretend to be dead 17 times, as we see in almost every other category in insurance. You look at car insurance as the worst offender, but even something like BoughtByMany, you could have people who are, I don't know, kind of hypochondriac around their French bulldog and are claiming constantly. How do you filter that out? There's always going to be a difficult conversation at some point. The result of that is horrible net promoter scores amongst the industry. And while startups have great net promoter scores, and some of them are great, they also understand how to get a good net promoter score, which is you ask all of your customers as soon as they sign up and they've been through your wonderful online mobile experience, then you make sure they leave you a review. And that, I think, absolutely is the right thing to do, but it does inflate the NPS scores for the people who know how to play it. Look at eSure. eSure has amazing NPS. That's because they play the game. So why is there no love? Firstly, financially, this is a bad proposition. You are, over the course of your life, guaranteed to lose money on insurance, almost guaranteed. And from a sort of a purely day-to-day level, you are paying out money month after month after month, and you very rarely get any money back. So as a financial product, this is a bad financial product for people. The reason you do it is because you need to, because you don't have enough capital to be able to manage through the really bad times. But yeah, if you can afford to self-insure on most risks, you probably should self-insure. Most of these people in this room should not have mobile phone insurance, should not have car rental excess cover, should not have bike insurance, because most people in this room can cover that cost pretty easily without it affecting their quality of life. Sophie talked a lot around the claims issue and the fraud issue, and I think that is one that continually comes back. I think the other challenge that insurers have is the low frequency of touch points. So you buy your insurance, you pay the insurer 12 times over the course of a year, and you probably don't speak to them during that period. And it makes it very hard to get someone to love you if you're never talking to them. And I think there are a number of companies, including some of the guys in this room, who are working on fixing that, but it's a hard problem to fix. How do you get someone to be excited about a weekly interaction with their insurer? This doesn't mean that it's not possible to disrupt insurance. It doesn't mean that people are going to stop buying insurance. People want insurance. They can trust insurers. They need insurers. And absolutely, companies can break through. But to my mind, you look at where the success has been in this industry. It's either by going where people are already searching for insurance, which is a price comparison websites, or it is that when they are buying something else that needs insurance. So the kind of insurance at point of sale, the Zhong'an type model. You look at companies like Lemonade and Trove that are explicitly trying to be loved and making this real a play about being loved. Trove I can't talk about because Sophie will hit me. So I won't talk about Trove. I'll talk about Lemonade because I don't think there's any Lemonade investors in the room. Lemonade's premium in the first half of this year was $433,000. They make a big thing about how wonderful their claims process is. And yet they don't cover flood risk, and even then their gross loss ratio was 140%. So you look at these companies that have raised a lot of money, it's very unproven they can really get customers to love them. So I'll stop there. Just to conclude, I do think there is a lot of opportunity in insurance. I'm hugely excited by this as a sector, but I think trying to be loved is the wrong way to think about it.
Thank you very much. Open to the floor. I'm going to just let the microphone run wild, so I'll start at the front.
Thanks, Oscar. Rob, I thought you made a great point about how insurers possibly used to be loved, but I would actually posit to you that maybe customers don't want to love their insurer at all. You know, we talked about a trade-off between sort of customer service and price, and I think maybe, you know, I wonder if the analogy is actually closer to airlines and budget airlines, you know, which puts us down to what, you know, us Brits typically, but possibly everybody really loves, which is a good complaint. We always say that we get off a Ryanair flight for 2 hours and say we've had an absolutely miserable time, but the next time we go on Skyscanner, we still buy the Ryanair flight.
If you want, let's circulate a bit for it. Yeah.
Sorry, Mike Hogg. I've already asked a question. All I hear here is love your broker. You know, we're talking about insurance. Well, you can trust me. The customer's friend is the insurance broker, and I know there's a lot of people in this room that want to disintermediate the broker potentially, but you've invested in one effectively, and we heard very succinctly from Stephen earlier on, who's got a lot of plugging, by the way. I'm loving that. That you don't need a license to disrupt insurance. To love your insurer, I don't think it's possible. I kind of agree with Rob, but you can definitely love your broker, who is your friend in the event that the insurer lets you down. And certainly, I agree with Rob. I think insurance should be a bit more intimate with its customers, because you can't have love without intimacy. And ultimately, the intimacy of insurance, it's not nudity, don't worry. It's exposing the claims ratios, which no insurer does, and the first one to do it will probably get a real kicking. But that ultimately is the reality. You don't know how many claims an insurer is paying out and what the ratio is of margin going on, and that's where the ultimate trust comes from, and the lack of it. You can't get love without the intimacy element, so until that happens and BoughtByMany start releasing their loss ratios, I don't think the love element is ever going to quite be there.
I'm really sad. I've loved an insurer. Hiscox, back in 2003, they just launched. I had a claim, then I put through my claim on email, and then they didn't get back to me. So I rang them up in a fury 5 days later. Like, why haven't you got back to me? You said you'd get back to me. No, sir, the money's already in your account. I assure you, I loved them for a long time after that. And it's a fairly trite example, but if you look at the industry as a whole, that sort of response is actually easier done via direct, where you don't have to faff about with someone in the middle, or at least if they're in the middle, it's technology. And I just sort of refute the idea. But yes, you can absolutely love your insurer. Seeing the feedback we get when we tell people we can't give them insurance because they forgot to put the fact that they had a claim last week on their insurance application. And if you deal with them the right way, some of them are actually like, oh, you guys are so nice, and they want to give positive feedback. So you can be loved. You just have to be transparent, and you have to do what's right.
Oh, sorry, let me just, ladies think I saw her arm over there. There you go, no worries.
Thank you. Dorota, as you know, I run consultancy business and I help with digital transformation for banks and insurance for 20 years now. First, I wanted to say that industry is guilty of not having customer trust, because for many, many years, we actually, as industry, we are trying to disempower customers. If you just studied headlines of the marketing campaigns, which I did because that was one of my projects, for last many years, from all the insurers around the world, I looked at life insurance. It will be all about, can we have you under our wings? Don't worry, we will take care of you, let us take care of you, and so on and so forth. In other words, we are telling the customer, without us, you don't even try to think, don't even try to come close. Insurance is too complicated. And so we obviously make the insurance, relying on the third parties, on the brokers, etc. And I don't think this is the right way for customers, to feel. They want to feel that they are making the right decision. How often we have those claims that customers are buying the insurance product and 2 days later they are thinking whether they did the right thing, because they cool down and they think like, oh my goodness, maybe I shouldn't have taken it. If they understand the product very well, they shouldn't have a second thought. So that's number one. The number two, I'm really sick and tired, frankly, with the argument that, oh, banks, they have interaction with customers daily, but we don't, like insurance segment. Honestly, with all the new technologies being there for so many years right now, the insurance has such a power to move not only to protection, but to prevention, and give so many reasons for customer to love insurers for the fact that they can save customer from the events that may happen. And this is not happening today. Or there are obviously more and more startups, and not only startups, incumbents also trying to find a way to do it. And I think this is the right way to do it. You need to start thinking about how to help customer not to get in trouble in the first place. And this is where you can engage daily, and you can, build routines, and you can build communication, etc. There are a million ways how to do it. So, I think if those two were fixed, this would be the good starting point for that trust to be built, and with trust, the love. And now I work with one of the biggest life insurance company in the world, and we did the study in which we ask customers, or we try to find out what's the biggest factor behind buying the insurance. So what's the most important thing for customer to buy the insurance? And we did it in countries around the world, 54 countries around the world. We asked the same question. And with some variety, obviously, in percentage, but by far, the first argument for customers was that they are buying the company they trust. Because they cannot go through every single point, like pricing, distribution, etc., etc. What they do first, they pick 2, 3 companies that they trust, and only then they go through comparison of the offers. So this is, this is not a brainer anymore. We need to win customer love and customer trust, because otherwise, those that will be successful and will win it, those will sell products. That's it. Thank you.
I'm just quite conscious of time. I think we might need to, just wrap up with a final, thanks. Right, so closing arguments now. Over to Rom on this side.
Yes, I'm going to try and pick up on a couple of the points. So thanks for the input, guys. Couple of points. Firstly, one was around price. We are so far away from the efficient frontier. So you can deliver love, fantastic service, interaction, and actually a great price point, a better price point, because we don't have that bloated cost structure. We can be smarter about fraud, which I agree is an issue, but filing claims, doing claims by video, you can, and there are companies, not BoughtByMany, other companies, right, who are doing this, and it is fascinating to see that customers love it. But the chance of you doing a fraudulent claim when you're doing it talking into your phone is significantly lower. It kind of makes sense, yeah? And you're doing it within a time window of the accident actually happening. It's significantly low. You can turn it around, point to your car, talking to the thing, and you get it. So there are ways to disrupt. And we're kind of arguing on the same side. We're saying there are big problems with incumbency. But by God, what an opportunity. What an opportunity. And I suppose my premise is done right. And wherever you play in the value chain, I also happen to believe those closest to the customers, often the brokers, but I think there's a kind of artificial distinction. The wonderful thing about particularly the general insurance value chain is it's so fungible. It's a bit like the license question. What are you talking about, a license? You can play in all kinds of segments. You can start here and you can end up over there. This is brilliant opportunity. And my God, it's down to all of us to go and capture that and change it. And by doing so, we will actually make a massive difference for customers that they will recognise. And it won't be just a regretted purchase. It will be something that they actually really appreciate. Does it get you into, I want to jump into bed with you? No. But does it get you into a place where we can transform the trust? Absolutely it does.
And finally, on the against side?
Yeah, so from the different questions, maybe don't want to love the insurer the broker and the mitigation. I think it's around this feeling about my insurer cares about me as a customer, and care comes with a more individual relationship, and this is where the opportunity is. This relationship that existed in the beginning and that exists in the fantasy of people when we speak about wars, when we speak about tornadoes, when we speak about terrorist attacks, where there's really this idea of the insurer cares about what's happening. This needs also to be translated into the small policies sold to average customers. This is a huge challenge. I'm not sure we'll get to it, but it's certainly worth trying it with good ideas from startups.
Nothing to add.
Okay, well, all that remains is for us to have a final vote. So, as a reminder, the debate motion is customers can be persuaded to love insurers. And when we voted at first, people were pretty much overwhelmingly for loving insurers. So, finally, hands up, who thinks we can love insurers? It's pretty consistent. And who thinks we can't? We can never love our insurers. I think you've made some progress there. Another Jeremy Corbyn victory there. Yeah. And then, yeah. That is the end of the formal proceedings. As I said at the start, it's an experimental, first of its kind, the Balderton debates. So please do let us know what you think worked, what you liked, what could have been better. Any feedback's welcome. All that really remains is me to thank all the panelists who've spoken and put their necks on the line this evening. Thanks, Balderton, for hosting, and thank you all for coming.